US stock markets remain stuck in a range after tech price action disappoints. The dollar pulls back on a dovish FOMC meeting, and sleepy gold ignores real rates at record lows. All this and more in this week's Macro Insight. Okay, so welcome back to everyone. Welcome to Macro Insight. Today's the 3rd of August. Welcome to any new subscribers, any trialers. So what's been going on in markets? So last week was all about mega cap tech earnings, as we all know. And despite most of them beating, except Amazon, they were met with pretty poor price action. So you had all the big mega caps pretty much showing down on the week. Microsoft 1%, Google 1.5%, Apple 2.5%, Facebook about 6%, and Amazon about 10%, right? So pretty disappointing price action for those names. Now, despite that, markets didn't really do a whole lot, right? So broad markets still managed to end up pretty flat, with the S&P stuck in about a 1.3% range. Share the screen here. So you can see here, if we zoom in on sort of S&P, what it did from sort of the 27th, it's just been kind of ranging, right? So lower end of the range around 43.70, 43.75, and top end of the range around 44.30. So again, exhibiting that price action where we kind of go slightly higher and we get stuck in the mud, right? Where dealers are long gamma and we can't really break either way. So that's what we saw there. Obviously, NASDAQ, the one containing the techs, pretty muted as well. If anything, it's kind of coiling. We're seeing this coiling price action. We came off a bit initially, bounced. NASDAQ not really shaken despite arguably, bad post-earnings price action from those big mega caps. Now some of that you could probably blame on yields, because we know the NASDAQ seems to be better supported by bond yields going lower due to people, seeing tech as the duration play. So if we go to bond yields and have a look at the 10-year from around the 27th, you can see that we were up in the kind of high 120s on the 10-year. And we've kind of drifted our way down, and we've accelerated, yesterday we accelerated on the not so great manufacturing data out of the US. But I would argue that, that bond market price action is probably what has supported NASDAQ. Otherwise, we probably would have seen NASDAQ a little bit softer than we did see it, given what happened to those big mega cap techs on earnings. Yeah. So after, fairly eventful FOMC meeting, all eyes are going to be on Jackson Hole now at the end of August. And, and I'd say that's probably, as I've mentioned before, that's probably the reason why the VIX has been trading higher, despite, what we see as pretty low realized vol and the market's grinding higher. So I'll bring up the VIX here. So we can see here the VIX since kind of the start of July has been making higher lows, right? Despite the S&P eking out new highs, the VIX doesn't seem to want to retest those levels at 14 or 15. And we explained why that was, right? I said that as we approach the start of August, the 1 month window, which now captures the Jackson Hole date, that's going to encompass that what is perceived by the market as quite a key event. So don't be surprised if the VIX spot actually trades higher into that. And we knew the August futures were reflecting that. And now we're starting to see, unlike normal, where you see the futures rolling down towards the spot price, we've seen the opposite with the VIX spot rolling up towards what the futures were pricing, because it now contains this date, right? Now, some people are saying that, you know, after the relatively dovish FOMC, Jackson Hole probably isn't as big an event as we thought, but, you know, we are going to get more data out of them, I believe. So, you know, still, it seems like the market is pricing it as some kind of event. Maybe it's not as important as we thought. Maybe the September FOMC meeting is going to be more important. I guess we'll find out as we get closer to it. But basically, that's what's going on with the VIX. And, you know, that's even more kind of confirmed when you look at the realized vol, right? So if we look at kind of my VIX Central page with VIX spot at 19, and you look at realized, well, 10-day, 20-day is more like closer to around 10, 11. So the implied realized vol gap, if you compare it to just VIX spot versus realized vol on S&P, that's a massive gap, right? And that's the only way you can really explain that gap is the market perceiving that there is an event embedded in that 1 month window, and that event is Jackson Hole, basically, right? So, you know, volatility price action suggesting that the market does see risk in that on that event. You know, the dealer landscape, the dealer gamma landscape that we keep an eye on via our friends at Spot Gamma, that's been shifting higher. So that's been suggesting lower vol, more of the same, provided the S&P stays between 4,400 and 4,500. That call wall has shifted up to 4,500. And, you know, their kind of gamma, their zero gamma line is around that 4,400, which we're kind of flirting with right now. So I would say, you know, that level we looked at, that bottom that we saw last week around 43.70 is probably your main support level. If we get below there, the picture kind of changes somewhat in terms of dealer gamma landscape. We probably run out of that local gamma positioning. The fact that we've got an elevated VIX tells us that downside vol is well bid, skew is well bid. So likelihood is if we travel down there, dealers are going to be short volatility against clients who have bought it for protection. So we may get a lot more kind of choppiness down there and some sort of liquidation type moves should that level break, right? But whilst the market kind of hangs around above 43.70, 43.80, we're going to get that grind up towards, you know, 44.50, 44.50 to 4,500, I believe is the area where the street has the most longs. So that will be where the vol will just get sucked down towards that sort of pinning effect that we may get into August expiry if we see a bullish market over the next 2 weeks, basically, right? So that's the thing to watch out for. In terms of, you know, causes for concern, what's been going on? I mean, obviously the bond market's a bit concerned on growth. Now we've seen the US vaccine rollout stalling and hospitalizations rising from what we see in the data. Is that going to be an excuse for more lockdowns? You know, Biden's certainly been talking like he's not scared to do more lockdowns if they need to. But, you know, if we look at the UK as a model for what's kind of happening, they reopened, right? Because the death rate just isn't there. So if the death rate's not going to really rise in any meaningful way, then hopefully we can avoid lockdowns. But it's something we need to keep an eye on, right? The Delta variant is now supposedly spreading across China like wildfire as well. So, you know, something to keep an eye on for sure. But the market's not reacting too much to it because it seems like the bar is quite high, the hurdle's quite high to really go full lockdown again, right? We need to see a massive uptick in deaths. And truth is, treatments, people are better at treating this thing now, right? There's various treatments that are proving to be quite successful. And that's probably keeping the death numbers down, as well as, you know, the impact of vaccinations, let's say, okay? Manufacturing data out the US, obviously yesterday was helped to take yields down a bit disappointing. We have been seeing economic surprises generally rolling over kind of across most regions. So we knew that. We knew we were going to get a bit of a peak in growth in the summer, and the rate of change in terms of macro data is coming down. Shouldn't be a major surprise there. We probably had hope that the service sector was going to take up the slack maybe a bit from the manufacturing. That's kind of not coming through as quickly maybe as we would have liked. Last week we had discussed, you know, some of the service sector kind of lag was because of this kind of work from home dynamic, right? Where people don't really want to come back to work. They want to go back out to socializing and to venues and things like that. They don't necessarily want to go back to work in the office. And you've got this entire office adjacent economy that is more of a service economy, and that's going to struggle if people don't go back to work, right? So there's been surveys, people have done surveys saying, claiming that their productivity is anywhere between minimum about the same and like up to 20% better if they're working from home, right? And if people don't have to waste an hour each way on a commute, clearly that's going to improve their productivity, right? So I think some permanent changes have happened post-pandemic, and those might kind of cause a bit of a lag in terms of that service sector recovery, basically, right? Now, clearly the big risk that everyone's scared of is China, right? And we've seen big crackdowns coming out of China on a number of fronts. And so, there's been some analysis done by Goldman, which is quite a nice one. So they're looking at global growth. They've got various sort of indices or whatever they look at for a global growth proxy. And then they're looking at China proxies, right? Whatever they may be. And they're trying to see, what this kind of rollover in China proxies is likely to do to global growth and how much it leads it. There's a pretty strong correlation between global growth and this China factor, basically, right? So, and that's increased over the last sort of decade, where China is more and more important, obviously, to the global economy. So there is a risk that what's going on in China and the kind of Chinese government's approach and the crackdowns and what they're trying to do is going to filter through to global growth at some point. And that is kind of the tail risk now that seems to be emerging and that people are scared of, right? Now, if you think about what's going to be the most impacted by that, well, clearly Europe is generally quite fragile to a massive issue coming out of China, and it has been historically, right? So this was a really nice chart that someone put out, a scatter graph to show if you're looking for hedges, if your risk factor is China, then what are the indices that are likely to be the most impacted, right? And then where is it you want to own puts or put protection to get exposure to a kind of drawdown in the markets? Because clearly we haven't had a 5% S&P drawdown in probably like 180 something days. So, people are like wondering, is there any point in buying S&P puts anymore, right? So if we look here. So this is short dated European put spreads, right? So the reason I say European is because you look at this scatter graph. So this is basically saying that if you get an MSCI World Index move down by about 5% in a month, right? If you then have a look to see on average what the other indices do, then you can see which ones have the most bang for your buck in a broad global correction, okay? So you can see that the ones that seem to be, so that y-axis is telling us the size of the drawdown. So anywhere from 7% to 11% drawdown. And on the x-axis, we've basically got the price of a put spread, of a 1 month put spread, if you did it on any of these indices, right? So basically anything that's kind of in the lower half and towards the left, i.e. the put spread pricing is cheaper, right? So you can see that CAC, Eurostoxx and DAX are kind of lower down. So we're getting a 10% odd drawdown. If we get a 5% drawdown in MSCI World, we're getting a 10% drawdown in those indices, and the price of the put spread, 1 month 97, 93% put spread, so a 4% wide put spread is coming in at around 50 to 60 basis points, right? So you're getting pretty good bang for your buck in terms of leverage to that move down, because you're only paying 50, 60 basis points for a put spread that could go in the money at 4%, given that we could arguably get a 10% correction if the broader world indices come off. So it's quite a nice, I think it's quite a nice diagram that kind of represents and explains that and shows you. But ultimately what it's saying is that the volatility levels relative to the skew levels are such that put spreads look cheap, and they look cheap in Europe because when markets sell off, Europe tends to have a decent amount of beta to that downside, basically, right? So that's the idea. But I thought that was quite a nice graphic. And basically the point is, if you're nervous of what's going on in China and you think there's a tail risk emerging there for a broader global growth / global markets correction, you're probably better off putting your hedges on in Europe than you are in the S&P or the NASDAQ, basically, right? Even though those are the things that are still sitting at the top, there's probably a reason for that, basically, right? And we've seen it, right? We've seen, look at what bond yields do in a global sort of in a growth sell-off. Bond yields come off, bonds rally, and that supports growth names and tech names and kind of the S&P, basically, right? So the S&P just doesn't seem to be the instrument worth trying to put hedges on in and trying to put protection on in, basically. Okay. So it looks like, yeah, in terms of US equity risk, probably not time to panic. If you're looking for hedges, look elsewhere, it seems. Yeah. Okay, so then that's basically my thoughts on equities and where we are. I would say the things to look out for this week, you've got quite a lot of earnings still coming out, but it's not concentrated in one sector. It's kind of across regions, across lots of different sectors. So, you know, not one specific sort of earnings number that's going to move markets necessarily. On the macro data front, you've got US ISM services Wednesday, UK Bank of England meeting on Thursday, and US non-farm payrolls on Friday. So that's going to be the main one, payrolls. And, you know, it's going to basically be people are talking about, you know, is it a case of bad data is good data now? Because bad data is going to basically confirm the Fed tapering has to get pushed back. And so, you know, stimulus is going nowhere, that type of thing. I guess we'll see the price action, right? Post non-farms, we'll get a sense for if that non-farms number does disappoint and the market rallies on it, then that's kind of the dynamic that's in play now, right? But that is most likely. I mean, the odds are it's hard to see what non-farms number is going to significantly trigger any kind of risk off or bearishness, basically, right now. So that's kind of the world we're in at the moment, right? Obviously, I've been following the guys at 42 Macro quite closely, having gone into a bit of a deflation regime momentarily. You know, he's looking at us probably going back into Goldilocks, because he's basically saying whatever happens, any macro data that we see on the bearish side allows the Fed to kind of sit on their hands and keeps us in this kind of Goldilocks environment, basically. That's what it seems to be, right? So unless we see persistent enough inflation to kind of, you know, trigger a move in the bond market that kind of ties the Fed's hands, you know, I think we're in this environment that we've been in for a long time, right? Where the Fed just basically backstops markets, right? And risk markets can continue to rally, particularly in the US. Yeah. So, you know, what did we see in the dollar? That was really the only action last week post FOMC really of note, which was the dollar basically rejecting that level up near 93.5, right? So we were saying that was big resistance, 93.5. Odds were it was going to fail on the first test. That's kind of what happened. It didn't quite get there. It got to 93.20. We had a pretty healthy pullback back towards that 91.80 level. If you look at the rally off that low, I'd say the main support zone is between these two fib levels here. So between 91.30 and 91.80, that's probably where we're going to see our support now. So until that breaks, you know, dollar's probably going to consolidate, maybe have another little push higher. We'll see. If you look at kind of how the euro behaved, that bounced off a key level as well. So this was a very decent support level here that was forming. It kind of consolidated there for a while and then bounced strongly off that level. In theory, you know, if that level is now held, that does open up the way for another retest of that 122 level at some point in the euro, right? So we had said, you know, euro dollar vol had got very, very low. We were down at like 5.5-ish for September options, so that we got a move there basically, right? So if you had bought straddles, you're doing okay off that move. If you'd bought calls, obviously you're doing much better, but that would have required a directional bias basically. And then another trade I've been looking, I've kind of dipped my toes into is Aussie here. So Aussie, why have I traded Aussie? Basically, you know, Aussie's an interesting one. It's been getting beaten up quite badly recently, right? So Aussie, because of what the RBA were doing, because of the China kind of impact, and the fact that commodities were having a bit of a pullback as well, there are a lot of things that were putting pressure on the Aussie. And if you look, it was kind of starting to form a base, right? So it's forming some higher lows, and you know, sentiment in China is pretty beaten up, right? So the way I saw buying Aussie was a way of getting a little bit of short dollar exposure, a way of getting a bit of exposure to a China bounce, which was very oversold. Commodities are also bouncing and showing signs of life, so you get a bit of commodity exposure if you own Aussie as well. And then the RBA is also talking about tapering because their unemployment levels have come back to pre-pandemic levels, right? So you've got a lot of factors where it seems like a lot of bearishness is priced into the Aussie. And if you don't think the macro world is going to fall out of bed, and you know, let's say the S&P is a barometer of macro risk, and that's holding up, and you think that's going to continue rallying, then maybe the Aussie's got a bit of a bounce in it, basically, right? I also think that the lockdowns in Australia have been a little bit overblown, right? That's been bad for risk sentiment as well for Australia. But if you look at the actual numbers and the death counts and stuff, they're very low still, basically, right? So I just think sentiment for Oz got a bit overly bearish. Price action was showing me a bit of a base forming, and so I dipped my toes in with a buy there. I've got a relatively tight stop. I bought Aussie at about 73.40 with a stop around 73 back down here. So, you know, if we're back down here, then we kind of negate this base that's been forming, these higher lows. So I used it with a relatively tight stop. I'm not doing anything with it. I'm going to hold the stop at 73. If we get towards sort of 74.5, 75, that's probably where I take profit, basically, right? But for me, it was a bit of a mean reversion. Aussie's just been beaten up a bit too much, basically, right? And it's got a few exposures that I thought were worth. It was a way of kind of playing the China bounce without actually taking direct China exposure, because that can be quite volatile when it goes wrong, basically. So that was the idea. Okay, so that's where I am in FX. In terms of commodities, oil and copper have obviously, well, oil's having another little leg down here. So oil had a strong bounce, and then it's basically going into consolidation here. Pretty decent level here around 69.85 actually, which we're sitting on right now. So it's still, I'd still say it's a consolidation from that bounce. I mean, you know, it's right on a fib level right now in WTI. So I wouldn't say it's a massive reason to panic. Generally, you know, I think I took a bit of profit on my long. I bought some down at 67.5. I let some go at 72.5. I've basically been trailed on my balance now through 70. And, you know, if we get some more weakness, I'll be a buyer longer term, basically, right? Copper, that was a bit annoying. I got stopped out on that rally. I tried to play the short side on copper as a tactical. I got stopped out on the rally, and that's kind of consolidating now as well. That's a bit weak today as well, right? So that's sitting on a bit of a key fib level right now as well. So both oil and copper consolidating and kind of approaching key fib levels. We'll see if those levels hold. Personally, I think the fundamentals are pretty good on both of those, but we know fundamentals don't count for much in the very short term. So let's see if these things do hold. But on a longer term perspective, buying any weakness in oil or copper, still a decent trade in my opinion. And, you know, if you get weakness in those things on the back of things like COVID concerns or China concerns, then, you know, I think ultimately they will end up being opportunities to buy, right? China have already signaled that they're gonna kind of support their economy, right, if they need to. So that credit impulse that's been weighing on China, arguably they're starting to show signs that they're going to start easing again, basically, in China, right? So, you know, we may be reaching the end of that cycle where China's credit impulse starts to bottom out and go back up again. So if you see market weakness in oil and things like that, taking advantage of that weakness in copper and oil for a longer term perspective kind of makes sense. Yeah. And then gold really is the one that's kind of the head scratcher, right? So I think arguably gold is one of the most mispriced things at the moment, right? So you've got, generally the relationship to real yields is very, very strong. And the gap between real yields, which are now negative 120 pretty much, is just getting wider and wider, right? And I think there is potentially a big catch up coming in gold. Even as the dollar's pulling back, gold's not rallying. So I don't know what it is that's keeping a lid on gold right now. And so, you want to wait for price confirmation, really. So if we look at the price confirmation you need in gold, really, you need it above sort of 1830, 1840. Right, so this level, this resistance zone up here, it needs to break this level at 1833 to really get going again. But it's one of those things, gold can sometimes do this, right, and ignores things. And then when it finally starts to go, it has this big catch up. Now, I think that's what we're setting up for. I think buying short dated options in gold is probably was quite risky because we don't know when it's going to decide to wake up, right? So I generally prefer to park myself in the longer end of the curve on gold. And that's because I don't think the term structure is too steep. So I think longer dated options aren't that expensive. I don't think gold vol's that expensive anyway, but longer dated options, you're not paying a massive term premium for those. So I bought some March 22 gold GLD calls a while back. They've lost money because I bought them too early. But if you're looking to take advantage of what does look to be a bit of a mispricing in gold, and you believe that, it is going to catch up because, where are we? If you think that real yields are going to remain persistently low because economies are addicted to stimulus, and the only way to avoid stagflation is going to be ongoing stimulus, then I don't know. I kind of think this will eventually catch up. I just think because of the timing is so difficult to call, you're better off going a bit further dated, basically, right? So that's kind of what I'm doing. I'm thinking of adding to my position in those March 22 calls, but I'll probably wait for price confirmation, right? If gold breaks above 1840, that's where I get the green light to buy more of those. Because then I think you could scream $100 to $150 higher in gold fairly sharpish once everyone realizes, okay, we need to catch up to real yields. And it's got quite a long way to go to catch up to real yields, basically, right? Arguably, to catch up, if just off this graph, if this was to catch up to real yields, we're looking at closer to 2100 on gold is where we should be, basically, right? So we'll see if that transpires. But for me, if I look across all the macro landscape, that is one of the things that stands out as just looks to be a bit wrong in terms of the way it's priced. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.